Good morning, everybody. I'm sorry we started a couple minutes late there because we were having some technical difficulties, but now we're ready to go. But welcome to today's webinar being hosted by InPlay Oil, one of my top picks in our high yield income portfolio. InPlay is a Canadian junior upstream oil and gas company that I've been following closely for over 10 years, probably over 12 years now, I think. InPlay pays monthly dividends with annualized yield of 9.6% based on today's share price. On April 2nd, InPlay closed a strategic and truly transformative acquisition in the Pembina area in southern Alberta, which is InPlay's core area of operation. And that's very important because that's why they think there's going to be some great synergies and cost savings because they already have operations throughout that area. The acquisition more than doubles InPlay's production to 20,041 BOE per day in the second quarter, and that included 10,328 barrels per day of light oil. So prior to that, they were just at about 9,000 BOE per day and only like 3,500 of oil. So this is a significant increase in our oil production. Second quarter production exceeded my forecast because the company completed 7 new horizontal Cardium wells that significantly exceeded expectations. 2 of the new wells actually achieved payout in under 90 days. That's incredible. And that's with oil in the WTI in the low 60s. InPlay's production mix is approximately 50% light oil, 38% natural gas, and 12% NGLs. In addition to increasing current production, the acquisition has increased InPlay's drilling inventory to over 400 potential horizontal development drilling locations. I think half of those are considered tier 1. So joining me today is the company's founder, Doug Bartoli. Doug is the company's president and CEO. He formed InPlay Oil in November of 2012. Prior to forming InPlay, he was a president and CEO of Vero Energy, which I also was invested in for a while, a public oil and gas company from September 2005 to November 2012. He also previously served as a vice president of operations at True Energy and held management and engineering roles at Husky Energy, Renaissance Energy, and Pan Canadian Petroleum. So during the webinar, if you have any questions, please type them into the chat box. I already see we got about 10. And we will answer them after the presentation. We do have, InPlay's been one of our model portfolio companies for many years, so a lot of our members do own this one. So with that, I will now turn it over to Doug for an update on InPlay Oil. So take it away, Doug.
Thanks, Dan. It's been a while since I've been able to talk to your group and everybody. So this is great timing because lots to talk about here since the last time we chatted with the group. I'm going to jump right in. I mean, again, our strategy and our statement is a disciplined light oil company developing our high rate of return assets focused on free adjusted funds flow growth, conservative leverage ratios, and maximizing returns to shareholders. Now, when you take a look at these 5 points, this deal massively increased our scale and our quality. It was a 120% bump in oil production, 170% bump in total production. We expect to average over 18,750 barrels a day for the rest of the year. We'll talk about a little bit more on the guidance page, and then at the time, over 9,000 barrels of production. And it's massively changing our funds flow and our free adjusted funds flow. Highly accretive acquisition. It was 40% accretive on 2025 adjusted funds flow per share. And just as importantly as it's one of our keys in our investment statement, our strategy is 65% accretive on free adjusted funds flow. It enhanced our sustainability. PDP decline rate dropped to 24%. I mean, we have a PDP reserve life index of 7.1 years, proved 13.4, proved plus probable upwards of 19. And the inventory, which I have a great slide on and I'll specifically focus on. So yeah, our yield, 9.8% when we put the August presentation out. It's supported by 2.5 times of funds flow coverage on that base dividends. And we'll talk about that significantly, but we paid out 52 million in dividends since November of 2022. Never dropped those payments since we initiated that. And again, financial strength's a key, strong balance sheet. We had a great Q2, which again I will specifically talk about. We expect somewhere north of 35 million reduction in debt from the closing of the Pembina acquisition to year end. And we got a strong hedge program right now that's helping to mitigate risk as we're over 1x currently, working our way below 1x debt to EBITDA. Q2 highlights. So again, we closed the synergistic and highly accretive acquisition on April 7th. Production, as Dan said, was 20,401 BOEs a day, 62% light crude oil and NGLs. That was 1,000 barrels a day ahead of our forecasts. 125% increase from Q1 2025, and just more importantly, a 35% increase in light oil weighting from Q1 of 2025. Now, we also, when we put our Q2 out, we announced our production guidance that we'd be at the upper end. Now, our production guidance, when we first announced the deal in September of in February 19th of 2025, we put out an initial guidance. WTI was $72 US. We expected to spend about $80 million in capital on this property this year. When they announced that we closed, it was April 7th. We took over operations on April 8th. Of course, that was 5 days, give or take, off of Liberation Day. We had on April 7th, the day we closed, a whopping $55 handle on WTI. So we did not put our guidance out on the 8th, our new guidance after the acquisition. We waited until May 8th when we announced our Q2, and we got some stability in the oil price to $62. Well, we lost $10 in WTI, so we lost funds flow, free funds flow. But guess what? The assets we knew right away, and we announced this, were significantly outperforming. We now had, give or take, 5 weeks, 6 weeks of the new wells at a minimum. And we were able to maintain our production guidance, but drop somewhere north of 30% of our capital, which again goes right down to the bottom line on free funds flow and allowing us to again significantly drop our debt. Ultimately, the quarter had funds flow of 40 million, $1.49 per share, free funds flow of 35 million. We reduced debt by $26 million in the second quarter, and annualized on that quarter, net debt to EBITDA of 1.2x. We had 3 out of the 7 wells. We had one off that's basically on type curve, but we had 3 pads that came on, each one with 2 wells. The 2-25 pad is 300% above our type curve. Those 2 wells, they came on at the end of March. Those wells were number 1 and number 2 for Cardium wells in the country of Canada in April and May. Number 2 and 3 in May or in June, and actually July just came out yesterday, and they're still number 2 and number 5, and we have another well in the top 8 Cardium wells still in Canada as we speak. The second well pad on our lands was 75% above type curve. That's 14-33, and 8-1 was 25% above type curve. Between the base production and all these wells, we were able to comment that we're going to be on the higher end of our production guidance. Now, the next piece, we're very excited to welcome the Delek Group to our company. As a board member, as a significant shareholder. There was a vendor take back when we did the deal where Obsidian took back 32.7% shares. We've now been able to move that to a new shareholder who have a huge history of value creation in the oil and gas sector. They grew Ithaca from 29,000 barrels to 120,000 barrels in the last 6 years. They are a 45% working interest in the largest natural gas field in the Mediterranean with 23 TCF of recoverable reserves. That is operated by Chevron, who owns 40%, and then one other company owns 50%. So their company trades on the Tel Aviv Stock Exchange, and pretty much close to 80-90% of the company is focused on oil and gas. So they're very knowledgeable. They looked for a new jurisdiction, and they decided Canada was a good place to be. They felt it was a jurisdiction that was quite stable, contrary to always laugh to what everybody thinks at times. Yeah, we did a poor job in getting pipelines to Tidewater and other places other than the United States, but we can run our operations smartly, smoothly. You know, as in Ithaca in the North Sea, you know, they got a windfall tax thrown at them of 12%. So they, you know, they like the jurisdiction and they like the timing of getting in our jurisdiction. And we're excited that they chose us to be the group that they're backing with. We're very strategically aligned in what we want to do going forward. I think we now with them have a massive advantage over our peer groups. We now have a 35% shareholder, first lead order in any deals we do going forward. And you got to remember, we've had every deal we've done have been massively accretive and important to our company. So this is a strategic advantage that none of my peers have right now. So when you take a look at the Cardium now, the yellow is our land, and the orange is what we purchased in the Pembina area. We are the top producer in the Cardium, the largest light oil pool in Western Canada with 11 billion barrels of oil in place. You know, while we're on this page, I just want to comment why we love it. We were a little bit on the fringe, and we'll talk about this on another slide. And you can see our lands were a little bit on the edges in some cases, little less quality reservoir, less porosity. Now, when you look at the south of Pembina, you know, you can see our development of horizontal wells in the gray lines. To the west of the orange lines, you can see the development of horizontals with the gray lines. You can see the lack of development on the orange lines we just purchased. Very little development. It was not a focus of Obsidian. They are focused on some heavy oil assets in Peace River and the Clearwater. This allowed them to reduce debt, and it allowed us to take a key hold with a highly accretive acquisition that completely changes the sustainability of our company. Hugely undeveloped, which you know, puts us in a great position going forward. When you talk about the deal, again, 40% accretive on a funds flow per share basis. I think we would have been $4 to $4.50, and we're now $5.50 to $6 a share funds flow per share this year with this acquisition. We paid about 0.5 times PDP NPV 10 on a reserves basis. So PDP, proved developed producing, is a straight blowdown case, and it was accretive on operating income, as it was about 2 times 25 estimated operating income. On a standalone basis, you know, this at $65 WTI and a full year acquired, you know, there's about $80 million free funds flow capabilities from this acquisition. So fits right into our overall corporate strategy. Synergies. Okay, got 3 pots here. We got the corporate right away, more than doubled our production. We only added about 50% staff. As a larger company, we got access to better interest rates and better opportunities on that front. You take office space, you take all of those pieces. We see within the first year of about $5 million in corporate synergies. Operating. There was a lot of solid infrastructure that we acquired here. Oil facilities tied directly into pipelines. I think we only had 2 in Pembina before. We have about 6 now tied into pipelines. They all come with solid gas plants and takeaway capacity that may require a little bit of upgrades here and there, but lots of room in them. There's a few areas where we are not tied into pipelines and we're trucking fluids out of there. We are currently tying those facilities in to the new purchased asset facilities, and we're going to save. One example is there about 3,000 to 3,500 BOEs a day of fluid that will no longer be trucked at $4 a day. That's one of the examples, and there'll just be more of these that we'll be able to do over the year. And then finally, just on capital, the Cardium's been our focus. It has not been Obsidian's focus. We've drilled wells with them. They've drilled wells for us, and we've drilled wells for them as working interest partners. We tend to be 10 to 15% cheaper for drilling, completing, equipping, and tying in wells. So all told, in that first year, we expect to work our way and see 15 million of annual synergy. So this is a common theme when you do asset deals like this, specifically when it's so focused in our core area. We know it. I'll argue with anybody. We're one of the best producers in the Cardium out there. So in 25, when you take a look at the funds flow, mid-range of our funds flow, again, we only received this asset on April 8th. So I guess, you know, less 1 quarter in a week. You see about 130 million mid-range of funds flow. We announced in the Q2 announcement, 53 to 55 million, we'd be in the lower end of our capital expenditures for development capital. The base dividend is just over 26 million this year. That leaves 46 million of free funds flow. We are somewhere around, give or take, 60 to 65% all-in payout ratio with capital and dividends. That is the best of our peer group by far. And most of our analysts up here will all tell you that. So great spot to be, great acquisition across the board. When you take a look at inventory and economics, okay, we now have over 400 locations. We're going to only drill 5 to 5.5 more wells this year. We were able to reduce capital significantly from that February announcement. We call tier 1 inventory less than 1.5 years. We're using about $70 WTI to say that. We got just about 200 locations. I mean, if we're drilling 10 to 15 wells a year, we've got 10 to 15 years of tier 1 inventory. Okay. Now, I believe as we develop that, some of that 200 plus wells in tier 2 or in the red will become tier 1 inventory, just by offsets that are doing well, and we'll be able to move it in. Secondly, after 10, 15 years, if you're in the camp that I am, WTI is not going to be $60. It's going to need to be 80, 90, it could be 100. All of those extra 200 locations start becoming less than 1.5 year payout in tier 1 inventory. So again, massively changed the sustainability of our company. I mean, this is why we loved it. Okay, I zoomed in on the core of the play in the map. In the green, you can see this is the great acquisition we did during COVID or at the end of COVID that we closed in October of 2020. The green lands on the south and the one area in the southwest. There were 0 horizontal wells drilled here. We've drilled 16 of them. This acquisition has paid out since then, with all the capital we spent, 62 million of free cash flow on that little acquisition. Look at the lack of drilling all around it. This is what excites us. We have completely changed the inventory look of our company. Now, the yellow lands we acquired is the core of the field. The lands we had on the south and the west are a bit on the fringe, little lower perm, little lower porosity. Okay, we now got the core of the play. Now, when you look at the well comparisons, I'm using 3 companies. There's the gray lands in the map. That's the blue land. That's one of the offset operators. You can see they peak at 250 barrels a day. These are wells since after COVID. So do we. Now, we declined a little bit harder than the offset company on the gray lands or in the blue line. That's because of reservoir quality. Their quality was a little bit less. And then the acquired lands, which are in the heart of the pool, were only peaking at 200 and declining similar to us, but maybe a little bit less. This can all be explained in completion methodology comparison on the right side. This is the stage spacing of our frac intervals. So we were developing and changing the drilling and completion techniques in this pool. We were the leaders in this prior to COVID. In the orange squares, you can see that we figured out that the optimal fracking interval is about 45 meters of spacing. That's the orange square block. Of course, we had the big lull for a year through COVID, but we continued with that 45 meters. When the offset operator in the gray lands started drilling in late 22, they did the same charts and the same analysis we did. Guess what spacing they used? They used our spacing. They copied our drilling and completion techniques from the blue diamonds. Okay. What we purchased, they were doing spacing back in 21 and mid 21 after COVID, still up in the 90-100 meter spacing range. They slowly been bringing that down into some as low as 60 and still upwards of 80 in some cases, but they've been dropping those spacing. Ultimately, we're putting more sand in, we're accessing more reservoir, and we were able to get peak rates of the offset operator in grays well rates and exceeded the Obsidian rates, which had better quality than us. So we're going to be able to use our completion techniques, and we expect to potentially keep moving forward and have much better results than us, the offset, and even the prior operator of these properties. So it was a very, very exciting deal for us. Really quickly, on the overview, we announced we expect to be now at the higher end of the guidance. We have 3 wells coming on about the end of September, early October. We'll have another 5-6 weeks of production from those wells before we announce Q2 in early November. Increased our liquids weighting. We got lots of reserves with a proofless probable NPV10 of $1.4 billion. 28 million shares basic outstanding, market cap of over 306 million, enterprise value of 529. We got the monthly dividend of 9 cents a share. Our liquidity has increased significantly since before the acquisition. We're now sitting there, you look at this, we're anywhere from 1.2 to upwards of $2 million of liquidity change a day, which is pretty good for a company our size. Now, we'll talk a little bit more on the guidance, but as it sits today on strip pricing, we'll be quite a bit lower than 217 million of debt. We'll be on the lower end of our range, which is at a minimum is about 213 million. We got strong lending support with our lending capacity here. Directors and insiders own 2.8%, and large inside shareholders, which include, I'll talk about it on our board of directors page, but they own about 46%, and they are on our board. So we got strong representation of huge supportive shareholders. And here we go. My management team hasn't changed. We had a promotion of Rob Jameson when we done this deal, but these are strong technical people on this board or on this management team. Our board, Craig Golanowski, they've been with us and they put money into us in 2014, more in 16. They've never sold a share. They currently own just over 12%, and he's the chairman of the board. When I go on the other side, I go up the board, Dale Schwed, been in the business for over 40 years, a geologist by trade. Last fall, he sold Crew Energy to Tourmaline Oil for $2.2 billion. Steve Nikiforuk, chairman of our audit committee. I mean, he's chairman of Whitecap's audit committee. They just did a big deal with Varen. And now we have our 2 shareholders, our 2 board members from the Delek Group. Udi Erez is the chairman of the Delek Group, and Tamir Polakar is the executive VP and CFO of the Delek Group. Again, strategically aligned, very knowledgeable oil and gas people. Excited as hell, to be honest, to have these people doing business with us. Again, always talk about this. Per share growth and reserves and production is always a key. We're looking at 15% per share growth this year. Again, but maintaining capital discipline, prioritizing free cash flow in the current commodity price environment is very important. On the reserve side, again, 16% growth and per share growth. We've had top quartile 3-year average reserves adds, and we expect to be at the top of our peer group again this year. Again, strong track record of cash flow growth, debt reduction. Of course, 22 is the best commodity year I've been in since I've been involved in the industry. And again, I've got 34 years in the industry now. You can see we're now at similar to the cash flow in 22 with much different commodity price. I just did some rough math at one time, taking a look at a full year of our current assets at those type of commodity prices, and you're somewhere in the $250 million funds flow range. So set ourselves up really, really well. Focused on debt reduction. We have put a little bit of leverage on there, but our goal is to get below 1x debt to EBITDA as quickly as possible, which includes removing 35 million at a minimum prior to the end of this year. Again, this has been on for a while. I'm not going to get into it. The key is we've had 2 acquisitions, one during the end of COVID or the end of 24. Probably the best acquisition I've ever done, and some people say they've ever seen. But we took 190 barrels. It's currently doing 4,000 barrels a day. We've drilled 16 wells, built a facility, and we've now had 62.5 million of free cash flow come off of that. The value add on a reserve basis with the free cash flow, you're talking about 68 times PDP, on approved basis about 89, 90 times, like fabulous deal. But if you can do prairie storm type deals, which we did in 21, and we will be free cash flow positive there, we have to put a lot more money in infrastructure here, but even 2.5 to 6 times return on that initial investment, you do those all the time, you're going to make money for shareholders. Now we've got a larger one. Now it's not going to be this massive growth asset. That's not what it's meant to be, but it's going to be a massive free cash flow asset. That's going to allow us to rinse and repeat, purchase, drill, pay down debt, purchase again. It'll be part of our strategics view of how we look at things. Now, the other piece of that puzzle is when you look at it, every $28 million of debt we pay off, it goes directly to our free funds flow. If our EV DACF cash flow multiple stays at 3 times, if we reduce 28 million in debt, that's $1 per share. If we have a 3 times multiple, that's like a $3 value add on a per share basis. After paying the dividend, that's one of the most important things right now is to reduce that debt, get it down, put us in a position to continue to acquire. Reserve highlights: proved developed producing reserves. Value, we've got debt in here at the end of the year. We get about $17 per share, B10, 10% share value. Okay, 7 years of reserve life index on PDP. That's awesome. That's that low decline, highly free funds flow asset. Now, when you take a look at the total proved reserves, so total proved reserves are taking undeveloped locations with a probability, the reserve evaluators give you a probability of 90% of hitting those reserves and those numbers. That puts us up to close to $30 per share. Okay. I always relate, we trade on cash flow multiples, debt adjusted cash flow multiples. You were going to do $5.50 to $6 this year, per share. Could be $6 next year. Again, depends on commodity price a bit. If you get historic multiples ever of 5 times, that equates to the total proved number. We currently trade still below our proved developed producing case, which ultimately that will change. Okay, the forecast. So we've now put actuals in here till the end of July, and we've used $60 WTI for the rest of the year. That average is 63.10 for the year, gives us just under $85 Canadian on a par basis with our 72-cent Canadian dollar. We got AECO at about $2.30. I'll talk about our hedges there a little on the bottom of this. And, we now talked about being closer to the higher point of our guidance at 16,800 BOEs a day. And we talked about lower end of our capital guidance when we announced Q2, so $53 to $56 million. And again, we got 5 to 5.5 wells to drill for the rest of the year. That puts us at funds flow of 129 million. It has us at a free adjusted funds flow yield of 24%. Again, highest free funds flow yield out of our peer group. If I move that down into the mid-teens or 17-18%, that's a $13-14 per share look. So get a couple of great quarters under our belt. We'll be executing superbly. Ultimately, I believe we'll start reducing that funds flow yield closer to our peer group. And then debt. Just the way we sit today, we expect to be at the lower end of our debt at a minimum as well. And that has us about 1.2 times debt to EBITDA annualized for the year. Now you can see the sensitivities to $5 plus or minus on WTI and 25 cents plus or minus on AECO. We have about 75% of net royalty oil production hedged for the remainder of 25 at $62.10. And again, gas prices in Canada have been weak again in the summer. We expected them to be weak. We have 70% of our gas hedged for the summer and even 60+% hedged for the next year. But for the summer, we're hedged at around $2 and just over $2.24 per MCF. We're getting 70, 80 cents today. We went through this Q3 of last year. I didn't have no faith in it again this year. We came out of winter with high storage. We hedged our gas significantly to make sure that we didn't have anything like Q3 of last year. So, that's a Canadian phenomenon. It will get better in Canada as we get some LNG, but I always worry about the massive world quality assets we have in Canada in the gas space. And there is a lot of gas here. And I do think we cap it at some point, but hopefully we don't see these dollar and lower numbers. I'm more of a hopefully $2 to maybe $4 on the high as we move forward and go through the cycles here. But it's improving, but we're still a ways away from, I think, seeing massive changes in the gas. That's it, Dan. Reiterate strong shareholder returns. We're paying you nicely to wait while we get some quarters out, prove what we're capable of. This high net back, low decline asset will generate significant funds flow all the way down to $50 WTI. We've got a strong track record of delivering shareholder returns through the various commodity price cycles. Balance sheet is important to us. It's a new world out there as far as the industry goes. We've changed our ways from growth for growth's sake to free funds flow and return to shareholders as an industry. That's our focus. Again, providing us financial liquidity offers us flexibility to take advantage and be opportunistic as well. The sustainability, the number of tier 1 locations and just locations in general is huge. We have a strong hedge position at favorable prices, mitigates risk right now because we all know there's still lots of noise out there. And we just, again, have a high quality asset base that's improved, quick payouts in a well-established field with a large oil place and low recovery factors.
All right. Good job. Good job, Doug. Congratulations on making a great acquisition, man. I worked in M&A for Hess, and this is one of the best deals I've ever seen. So giving you that many tier 1 locations. I got a lot of questions. So people that are on here, really, you don't need to type anything in the chat box right now. I have so many questions that I can't believe. I got a bunch yesterday. I bet we have hundreds of our members on this stock, I'm sure. So, and a lot of them were kind of the same question. So first thing I want to do is confirm InPlay currently pays dividends of 9 cents per month, which is $1.08 a year. Does the company plan to keep paying the dividends at the current rate? And at what oil and gas price would you need to cut? And then have you considered stock buybacks? I try to put everything in one question. So.
Yeah, that's a good question. I mean, it kind of covers, the return to shareholder strategy across the board. And I think I talked a little bit about it in the presentation, but ultimately, I mean, we're happy where it sits today.
Yep.
Our plan is not to cut that dividend. I think the issue starts getting a little bit more touchy. Our strong hedges in place mitigate a lot of risk. The issue, you start getting a little bit touchy around $50 WTI, but not if it, like when we hit 55 and didn't look good on April 7th, like we didn't panic because I mean, it's not about $55 in a day, in a month. It's what does it look like? What is the supply demand telling us going forward? Is it going to stay there? So we got to see $50 for quite a few months, and believing it's going to stay there for us to have to cut with our hedging program, with our free funds flow profile. This is not unsimilar to just about every company I know of. I mean, I've read oilprice.com articles where they're talking about the share buybacks will drop off significantly with most majors at $50 WTI.
Yeah.
There's the number. Again, I can tell you, I have charts. I've seen charts since early 2000s. Anytime we've gone below 50, there's only been a couple times it's lasted more than 6 months, never much more than 6 months, and it comes back harder. So again, with smart hedging, with this new asset and the free funds flow that's producing off, out of my mid to junior to small mid cap companies, got the lowest all-in payout ratio out of all of them. So we are in great shape. Now, as far
I got a research report from a highly respected research firm the other day, and they said if oil would drop to 50, and this is all based on the fear that the tariff war will cause a recession and all that. And basically, they said if it did, it would be very short lived, probably days, at most a couple weeks, if it dropped to 50, because you would see upstream companies slam the brakes on their drilling programs like crazy, and it would drop off quick, and then rebound. And personally, I think the right price, I think the seeds have been planted for the next bull run on oil. And I think the right price is 75 to 85 US. So we'll see. But yeah, I just wanted to confirm that. And I know you're not considering any stock buybacks at this point, are you?
So yeah, and I kind of mentioned in there, we're not considering buybacks at this point. We'll look at it a little bit down the road, but you can't, that math I showed you on $28 million of debt reduction equates to an extra dollar on the EV/DAC-F. You get 3 times multiple on that. That is by far the best thing we can be doing right now. Plus, it shields us from low prices, right? Like for a short period of time, as we just discussed. So that's the first priority by a long shot. I mean, we announced Q2. Summer's a bit of a hard time to get out. We now are going to have a very heavy marketing campaign going into the fall, getting out, telling the story. We'll see where we get through after all that. Again, I don't think people understand the outcome of this Delhi group coming and joining us, but that will start.
I want to talk about that for sure. I did get a question about, what was it, several months ago, you did a reverse stock split. You went 1 for 6 to get the share price up. And actually I wouldn't see any need to buy back shares. I mean, your share count is relatively low. I mean, really low for a company with this much production.
Yeah, I think the share buybacks is more, do you believe you're trading at deep discount? So it doesn't matter what the share count is or anything like that. It's more about, I think most people buy their shares back because they believe they're undervalued, and that's one of the big things to do. Well, guess what? I mean, share buybacks are done with after-tax dollars. Paying down debt not only reduces my interest payments, but it also, creates huge value on a per share basis. So that's our priority. Plus, again, it allows us pay it down. We'd like to get to under 1 as quick as possible, 0.75. It allows us to rinse and repeat on the acquisition front. And our track record of acquisitions is spectacular. Again, my peer group does not have this strategic partner that's a 35% lead order on every equity deal.
Right.
And there's not one of my companies that have that. We believe the institutions will follow in behind that. Like Delhi Group has a strong following of huge institutions. BlackRock is one of the bigger shareholders. Like, again, the dynamics of this. And these institutions aren't buying on the market, but you do a deal, they come in, right? They want to put in lots of money. They don't go out and buy in the market. That's not their goal. I've talked about this many times. We've lost the resource investment firms over the years. There's very few left. You need the generalists to come. Well, they need a sign, right? I mean, $62 oil or $4 today is not a sign, right? They need it to change. So, they'll come back, and they'll come back with a vengeance. So
yeah, I believe so. Have you talked, to Delhi Group, are there other acquisition potential within Pembina that you could bolt on?
There's acquisitions throughout the Cardium play, Pembina, Willie Green. Yeah, but we're not going to be totally limited to that area. I think in general, there's going to be other places. I don't really see us, trying to go compete in Montney and Duvernay in Canada. Like, it's a large company deal, and it's the infrastructure is a big issue within that place. So again, the amount of capital required for that is substantial.
Yeah.
But again, we'll be focused on, as it sits today, until I see a structural change. We won't get aggressive on gas assets. Again, I'm quite frankly, you can tell I'm not overly constructive on it, even though it looks better. It's still and it's going to need some time to figure it out here in Canada.
Yeah.
So we are focused on conventional assets, uh, low decline, again, free funds flow. Those are all a part of it. Again, we continue. That's another point. Like every time we do an accretive deal, that's 20 to 40%, right? That's going to be massive value creation. I see these larger companies that are merging, and you're seeing a little bit of it. And you're going to see more of it. At some point, they're going to divest in some of their the conventional assets that are no longer their focus, just like Obsidian did. And they're going to start focusing on their Montney and their Duvernay as they start building it out. Maybe they have an acquisition to do and they need a quick sale. Like there's going to be these opportunities that are going to start presenting themselves as we move forward.
Yeah. The okay. Okay, Harry Van Neck is our petroleum economist. He posts daily on our chat room, and with some really good detailed stuff. And he worked for Shell for many, many years. He was Shell's chief economist there. He follows like 82 companies, and he has you guys, you're in his top 10 based on net present value per share. You're in his top 10, and you're in my top 10 too. So, he's got kind of a long-winded question here, but let me get to it. 2024 was low in reserve bookings, and that was before this deal. The 2024 autonomous bookings, like what you booked per your as a result of your drilling program, excluding debookings of 325,000 BOE for economic factors because of low oil and gas prices, were only 1,587,000 BOE of additional proved reserves compared to your production of 3.2 million BOE. So do you expect that with the new Pembina assets included, that InPlay will have higher autonomous bookings in 2025 because of these wells you recently completed and the 5 you're going to complete by year end, such that you can replace your 2025 production?
The simple answer is yes.
Yes.
Again, they're going to look by area, the reserve values. They've got a pretty strict policy on there. But we're going to have some winners and some losers, which is typically what always happens. But again, the key is we have a lot more winners, and I shouldn't say losers, but you got stuff that beats the numbers and stuff. That's just the statistics of the oil and gas industry, and some that's maybe a little lower. I would say we're quite a bit ahead. So the quick answer is we'll have a great reserve report this year and going forward.
The 3 wells from that pad that you're going to complete by the first week of October or so, are they in an area where you would expect them to come on at higher than the type curves, like in that 400 or 500 barrel per day?
Yeah, so that's a good question. So the answer, let's go back. We when we did our type curve for our initial forecasts and what our forecast is based on, we took the last just under 4 years of drilling around us for those forecasts. Okay. But specifically on the assets acquired, as you see on that one chart, they started increasing the fracs, reducing the spacing, increasing the fracs and the amount of sand they put into the zones. And they got better and better. If I take the last 15 wells, sort of in the last, I think, just over a year and a bit, they're about 68% better than our type curve. So again, we want to be conservative. We want to make sure we beat our numbers. The 3 wells we're drilling in right now, these are 2 to 2.25 mile wells. Everything's going great so far. So these are long wells, which is another great piece with a contiguous land base like this. They are in an area where low recovery factor, high pressure. You got to remember, like Pembina was found in the 50s and the 60s, delineated in the 70s and 80s, strong water flood put in place, kept the pressure up. So we know what the pressure is down there. Pressure's high, reservoir quality's high, and recovery factors are low. So we based on anything we have in our current type curves, we expect it to be outperform performance there as well.
Well, okay, the other 2.5 wells, and when you say half well, so are you the operator of the other one, the half well?
Well, there's, so we've got, let's see, we've got some, no, so we got some non-op wells that
Oh, okay.
it could be
Okay.
anywhere from 0 to 0.5. I mean,
Okay.
they
So
have,
you just put a half to say because they could propose some wells by the end. Okay.
yeah, I mean, right now, at the beginning of the year, it was 0.5 with prices. We're hearing some waffling on some of them. So that's why that half well's sitting there. The half well's not going to make a difference in our
Okay. Okay. But
in
when but
any of our numbers.
the other two
So
wells that you're operating, when are they going to be completed?
end of October, early November. So
Okay.
that's slightly gassier area. Again, it's in our it's off. It'll be offsetting this 14 to 33 pad,
Okay.
which is our wells that came on in March. And again, those were 75% above our type curve as well. So that's where they'll be.
Okay. And yeah, but they produce more gas, so they come
Little
on.
gas. So you
They're
want to
so
get the
gassy, but they
flush.
come on strong.
Yeah,
Yeah.
you want to get the
That's
flush.
good, actually.
You want
Yeah.
to get the flush coming into winter gas prices, right?
Yeah. Yeah, and that's something one of the other companies that we follow, they were excited that their wells had a higher oil cut, but because of that higher oil cut, they didn't get as high a BOE production. But so what? I mean, the oil price is
Yeah.
what matters. I mean, the oil production is what matters. So, okay, so you're going to drill these five wells before the end of the year. Then are you going to drill anything in the first half of the year, or what are you thinking right now? You haven't said anything, but I mean, just based on what the oil price is?
Yeah. So yeah, we're gonna again in $60 range. We're looking at give or take, stay flat production. We see very little need. Again,
Okay.
this is part of the capital discipline. We see very little need to grow production. You're not going to get paid for it. That's the honest to goodness truth. And that's what we used to do as an industry. You're going to see the Permian drop. You're going to see the shale plays drop at $60. They've all said they need $65 to get a reasonable return on their programs. So $60, it's generally stay flat. As you get towards 70, we talk about a 3 to 5% year per year growth rate. You're probably on the bottom end of that, but in the 3 to 5% range. And as you get 80, you're at 5%, and you could go higher depending on your view and what the future curve looks like. But we organically, we don't have to get aggressive. Free funds flow, that discipline, nobody's going to pay you to announce aggressive growth in this time frame. We're paying everybody to be patient, to watch our quarters come out, watch our performance and how we do. And in the meantime, let's face it, the next real level, I do think we have room to move forward on stock price, but the next level is going to be a commodity price change. It's going to actually really move the stocks again, right? So why drill over drill inventory at low commodity prices? You wait a little bit, and you've got huge returns on these. Again, you mentioned it, the two wells on the 2-25 pad in $60 price environment paid out by the end of June.
I know it's unbelievable, really.
That's phenomenal wells.
Let me tell you, when I was at Hess, if we had wells pay out in 3 years, we were happy. You get a well that pays out like that, man. That's incredible. But I was watching a podcast yesterday, and in fact, I posted a link to it on our website. But what was funny is EIA. This is EIA. Just a year ago, they said U.S. oil production would not peak until like 2035. Their newest slide, U.S. oil production peaks next year. In 12 months, U.S. oil production peaks and then goes on steady decline. That's what they're saying. When that becomes the current belief that these, everybody believes drill baby drill, the shale wells areas will just keep growing and growing and growing. Not when you've drilled out all the core one areas, the tier one areas. They're going to flatline, and they are. Everybody I've followed, they say they are, and they're going to get more gas to oil ratio too. But anyway,
so real quick, Dan, on that, I'll just add to it, and they've got this tier one inventory, right? And again, Scott Sheffield, I've always admired. The year he sold, I guess, a year and a half ago now to they sold to Exxon. He's going to go on the board, but they wouldn't allow him to go on the board, Securities Commission. You know, sold it, went to Sierra, talked great about stuff. This spring he went to Sierra in Houston, and he basically says part of the reason we sold because we're running out of tier 1 inventory, and they were supposedly had the best tier 1 inventory in the Permian. Now, the other piece of that is like these guys are getting efficient with their capital, because like what Exxon's drilling 4-mile wells, but you're burning up inventory like crazy at 4 miles. Like you're burning up the land like massively with 4-mile wells. Sure, you got a little more efficient for now, but you're burning out land real quick.
Yeah, and you're like all your acreage is pretty much held by production, right? This new stuff you bought, most of it.
Everything's held by production. That's
Yeah,
correct.
so you don't have a gun to your head to go drill. You need to do it the economic way, and I firmly believe what you're doing. The paying down debt is absolutely the right thing to do for shareholders. That increases your per share value. Again, I think you told us this on the 225 wells. Dave, you're just in a really good place, right? I mean, and the better
yeah, I mean they're
better
offset
frac jobs.
Yeah, they're offset 2 good wells. But again, you know, they are gems, and you know, we would have never expected, you know, what they've actually done. Like, and that's kind of the beauty of these type of plays. I think, you know, there's at times more consistency within wells beside wells in the shale plays. With here, when you have long-term water flood, you're getting these pressure pods of high pressure areas, and you're getting banks of oil that water's pushed up to, and you're getting these areas where you got high pressure banks of oil that when you frack into them gives you these massive rates. And you know, I fully expect we'll see more gems. I mean, do we get 300% in our first 4 months? Who knows? But I mean, in all honesty, if I do 25% above all my drilling on my type curves, we're gonna exceed guidance, you know, every year with this inventory.
Well, what if let's say oil does get back to 75 or something next year, you got a lot of wells that would pay out easily in a year, right?
Yeah, 6 months or less, probably.
Yeah, 6-8 months at that kind of price. So that's incredible. Do you know? Can you tell us right now, just based on what you're thinking, what's the exit rate going to be? I'm in my forecast I got with these 5 wells coming on that you'll be about 19,500 BOE exit rate.
Yeah, you got a little higher than I would say publicly, so we'll leave it like that. But again, yeah, it depends when they all come on. I mean, we should peak. We would probably peak in late November, early December, and start a little decline going into the end of the year. But we'll be at that or higher at some point prior to that.
Yeah. And then next year I got a little bump up in production, but I am definitely believing that the oil price and the gas price, I think by the end of the year could be much higher. It definitely should be down here a lot higher. We got 3 big LNG export facilities ramping up here in the next 6 or 8 months that are going to push our gas demand up like 4 or 5 BCF per day. I mean, and you know, everybody talks about this. We got this extra gas over the 5-year average in storage. In one cold week, that could be wiped out. One cold week, because our demand with the LNG exports makes winter letter of demand this year, coming year compared to last year, 5 BCF per day higher.
Yeah,
that wipes out that surplus is you're comparing that surplus to the 5-year average. The U.S. gas market was much smaller 5 years ago, and it's just going to keep going up. So, boy, it's going to be interesting.
well, the U.S. has, like, again, they've done a great job and allowing that to happen. Where again, we, you know, completely blew it in Canada, and we're behind the 8 ball. I mean, the whole problem is with Canada is like in general, is, you know, we got one that's ramping up slowly. You know, they should be able to double that, but, you know, not long after, I don't know, year and a half, and then there's more potentially coming. But in the meantime, like, we had some peak rates this summer, and we don't have enough, like, we can't get enough to the US, right? I think they peaked this last winter when it was cold. I think at some points we were sending nine a day down there. But that was kind of the peak that we've ever done. So between compression and pipe, it's the same thing. We can only get so much down to you. So all that LNG, sure, it helps a bit, but it we don't have enough compression and pipe to get massively above that, that rate we had last winter. And they could do some things, it might get a little bit higher, but that's the most that will go to the US at any given time. So, and and then I just comment, like, we have massively, like, some of the best natural gas plays in the world
In
in
the world.
Canada,
Yeah.
the most economic plays in the world, and the liquid rich plays, they can make money at $1.50. I have no faith that they will have any control and eat up every room available of natural gas takeaway in this country.
Yeah.
I've seen it too many times here. Last year, when the storage was too high in the US and the storage was too high in Canada, EQT led the charge and cut back production, and a lot of them followed. Did you see that happen in Canada?
No.
No.
Yeah, they do. And that's the thing people don't remember. When I was at Hess, we cut back when the gas price went below certain levels, we choked back all of our wells in Louisiana that were high gas producers. Because why? We're not going to give it away. It's still in the ground. Why wait till the winter and just do it then? Anyway, there's a question on here from somebody. George writes a question. Are you using fracking or conventional drilling techniques? Well, yeah, you're using fracking, right? Okay. I think you pretty much answered. Oh, has frac sand cost, have steel cost of anything come up on the wells, or your well costs, completed well
No,
costs going up?
not at all. I mean, in general, just the rig counts are down both in the US and in Canada. So it's kept pretty much like that massive inflation we've seen from, I don't know, halfway through 21 into 24 is kind of subsided. You're seeing it sort of subsided like the last 6 months, 8 months. Nothing's really changed there. And it just goes back to activity. The rig count's down in the US, the rig count's down in Canada. So the pipe hasn't gone up. I mean, we can fluctuate with steel prices, but steel prices haven't gotten completely out of control. And again, with lower activity, there's plenty of frac sand, and we haven't seen anything on that front.
And so your cardio moist, you do case them all the way through the lateral?
That's correct. Top
Okay.
top to bottom.
And then it's just you're lowering the spacing between. That's the main thing, increasing the production, using more sand per frac, and getting better results. Yeah. Okay. Where do you sell your oil? Are you selling it locally? And this is a question I get about the tariffs. Your oil and gas is not subject to any tariffs, is it?
Correct. It's all part of CUSMA right now, and it's all exempt.
Okay. But where do you sell it?
I mean, it's a good question. I mean, basically, it's so Shell Oil Marketing sells 60% of our oil. Tidal Marketing, which is Enbridge's marketing arm, which is the largest oil pipeline company in North America, does a big chunk of the remainder. Like, when it goes in the pipeline, we don't care. But I do know where it goes. Like, the stuff in the Pembina area, a lot of it does go towards Edmonton. Some of the stuff further south. Some of it goes down Trans Mountain to the West Coast, right? Like, and then a lot of refiners in the Edmonton area are light oil refiners, so it gets used there. A lot of it gets used in Canada, and then some goes down the main line of Enbridge into the Chicago Basin. So that's a blended line. There's a couple lines, but there's line 3 and 5 are the big ones. That a big chunk of the light oil goes down that way too. So those are generally internal in Canada, some to Trans Mountain, and then some through the Enbridge area. There's some heavies that in southern Alberta that would go straight down south through Montana and Wyoming and a few places like that. But that's where our product goes.
Yeah. Hey, I tell you, I don't. You look with Peyto. I added Peyto to our high yield income portfolio. Whatever they do on hedging, just do what they do, because they have locked in some really good prices on their hedging. And I guess they can get their gas to good into the US or something, but they got some good prices. Any thought?
Nobody has as good as Tourmaline. Tourmaline has the gas. Tourmaline's got I mean, they got direct sales into the California basin, right? Like
well, yeah, then you got it. Yeah.
But I mean, you got to have size, right, to have that sort of power, right? And they have their own department doing direct deals, right? Like it's a interesting scenario.
Have you guys given any thought to uplisting in the US?
Again, I mean, Part of the reason for the rollback is to provide us that opportunity. If we just deem it's available, again, you gotta have be above $1 to list on any US exchange. So that was part of the thought around it. We've had that for years. Again, I still think it's a size thing. The cost to list there and maintain there is huge. You do not see a lot of companies our size, but as you get bigger and as our shareholder base, if it continues to grow in the US, it is an option.
Well, okay, Delic's strategy, and I'm hoping I'm thinking about this right. I believe they picked you as a company in Canada they want to build up a gas company with. So if you come up with another big acquisition, do you see them putting in more equity or what? Or could you, or like you said, there'll be other institutional investors then. Now that Delic's in, they'll feel safe about putting something in, right?
Well, Delic has a significant amount of capital they want to put to work.
They're big.
Regardless of other institutions. Us and our key advisors all believe that there will be institutions that just follow because we have that 35% lead order on any deal. And that will, like, these institutions all talk, they want consolidation, they want less small companies, they want more size. Again, you become more sustainable, you got better access to debt. Again, the intermediates, $1 billion plus, probably trade a full multiple higher than us. $2 billion, they probably trade 1.5 to 2 multiples higher than us. So you see it in the institutional when they get involved with the next level of company. They have not come down market cap very much, right? Selective. It's usually on a deal or something because they're just not going to go. They got to put lots of money to work, and they're not going to go on the market and pick away at shares. They need a reason to get in. I mean, we did add about 11 institutions on our last deal. Generally a little bit smaller, but we added 11 institutions. So you were getting the following, but it was the deal that got them in. So that's how they view things. But then once they're in, they will support it. They'll trade. They'll if they see it being low and they could be underweight in the sector or anything, they'll buy it. I mean, the other piece is when things turn, the large caps they're already trading at 6-7 times. They might move to 7-8 times. I think CNRL already is in that place. Right? When they see things turn, they take some money out of that, they put it into the intermediates, which are between 4 and 5.5, the odd one maybe 6 times, right? Cash flow multiples. That goes up a little bit. They'll start removing some cash out of that, and they'll put it into the juniors and the small intermediates, and then the multiples will start raising. So, but again, that's a bull cycle, where the belief that oil is going to be good for years. I mean, we started that in 22, but it all changed in June when Fed Powell said, "Oh, guess what? We no longer have a transitionary inflation problem. We got an inflation problem," and oil went from 108 to 10 US. Not long, started working its way down to 90, 80. Through the rest of the year.
I mean, yeah, I see. All we need is some certainty. I mean, the upstream company views say, okay, we can lock in $65 for the next 2 years or something. They're profitable at 65. Heck, all the companies that I follow, every one was profitable with oil averaging 63 in the second quarter. Every one. And if they're okay because they've got their cost down. But you get back to $70 or $75 and the investors believe that they have confidence it's going to stay in that range. It doesn't have to go to 100. You get $70, $75, and I think a ton of money pulls it, dives into the sector. I really do.
Well, you're right. And I mean, you've heard me say this many times over the years. I'm not an advocate of $90, $100 oil because it causes too many issues in the world. I mean, $75 to $85 with a weak Canadian dollar, we absolutely kill it. So it's the sweet spot, and if you could just stay in that range, will absolutely kill it. So
And
that's
it's
where
the same way. It's the same on gas, like you said. The Canadians, you don't need $5 gas or something. You just need a $2.53 range, and it's very profitable because the reservoirs are so strong. Yeah, we're blessed. I'm telling you, North America is blessed to have. I heard one day they said, they were talking about natural gas being the transition fossil fuel, the transition to all this wind and solar. It's not. Natural gas is the future.
Yeah.
Natural gas is the world's future for energy, for electric power generation, transportation fuels. It is the future. And that's why I think, Canada and the US are eventually going to be in really, really good shape on the natural gas side. Anyway, so I think we pretty much covered everything. So, man, that's great. And we're following you. We're going to publish an updated profile on you probably next week. I got several to keep catch up to down here. And then we'll get you down here for luncheon at the end of the year. I think you're coming down with Scotty, right? In December.
Yeah. December, our usual Christmas tour. Yeah.
Okay. All right, man. Hey, thanks a lot for doing this. And I'm excited. I'm really excited about Delic being in your number one shareholder now. I think that's fantastic. All right. Sabrina
We
wants you
are
to
as
get
well.
there. And yeah, we'll send you the replay link, and you can send it out to anybody you wish.
Great catching up. Thanks, Dan.
All right. Thank you. Bye.